Would like to thank all of you for dialing into INOX Leisure post-result earnings call for the quarter and half-yearly ending September 2018. The call will be initiated with a brief management discussion on the quarter and H1 performance, followed by an interactive Q&A session. As usual, the management team will be represented by Mr. Deepak Asher, Director and Group Head Corporate Finance, INOX Group of Companies, Mr. Alok Tandon, CEO, INOX Leisure, and Mr. Kailash Gupta, CFO, INOX Leisure. Over to you, Mr. Asher, for your initial comments.
Thanks very much, Ankur. On behalf of the board and the management of INOX Leisure Limited, it gives me great pleasure to welcome all of you. I'd like to thank you for the time and the interest you have shown in tracking the performance of this company. The meeting of the board of directors concluded about a couple of hours ago, wherein, apart from other things, the board sorry for that. Yeah. Okay, so the board approved the quarterly financial results for the quarter ended September 18, or what we would otherwise call Q2 FY19. These results have been uploaded on the website of the company. They have also been submitted to both the Bombay and the National Stock Exchanges for uploading on their respective websites. I trust you have had the opportunity of taking a look at them. We have, in addition to the financial results in the statutory format, also uploaded a quarterly earnings presentation. We will take you through some of the key features of the earnings, both financial as well as operating parameters for the quarter. And then, as Ankur mentioned, we'll open this for any questions you might have. We are doing a Y-on-Y comparison, which is Q2 FY19 is being compared to Q2 FY18, and H1 FY19 is being compared to H1 FY18. Revenue from operations went up by 17% from 311 crores to 365 crores. EBITDA remained almost flat at 44.4 crores last year versus 44.8 crores this year. EBITDA margin therefore shrunk from 14.3% to 12.3%. PAT improved again very marginally from 11.7 crores to 12 crores for the quarter. That's an increase of 2%. PAT margin therefore fell from 3.8% to 3.3%. Those were the numbers for the quarter. For the half year, revenue from operations went up by 12% from 699 crores to 780 crores. EBITDA improved by 7% from 120 crores to 128 crores. EBITDA margin fell marginally from 17.2% to 16.4%. PAT improved by 12% from 43.8 crores to 49 crores. PAT margin remained almost flat, 6.3%. And as I mentioned, the PAT increase was about 12%. Now, if you look at the breakup of revenues, as you all know, our revenues comprise of four key streams: net box office, net food and beverage, advertisement, and other operating revenues. So for the quarter, the net box office figures went up from 186 crores to 206 crores. That's a growth of 11%. Food and beverage went up from 67.1 crores to 94.9 crores. That's a growth of 41%. Advertising income went up from 32.1 crores to 37.8 crores. That's a growth of 17.8%. And other operating revenues remained almost flat. 26.4 crores went down marginally to 26.2 crores, as a result of which total revenues went up from 311.3 crores to 365.3 crores. Figures for the half year: revenues from net box office went up from 425 crores to 448 crores. That's a growth of 6%. F&B revenues went up from 155 crores to 206 crores. That's a growth of 33%. Advertising income went up from 65.5 crores to 77.9 crores. That's a growth of 19%. And other operating income went down from 53 crores to 47 crores. That's a degrowth of about 9%. As a result of which, total revenues for the half year went up from 698 crores to about 780 crores. That's a growth, as I mentioned, of about 12%. Net box office revenues now comprise of 56.5% of our total revenues. F&B comprises of 26%, which is up from 21.5%. Advertising comprises of 10.4%, and other operating revenues comprise of 7.2% of our total revenues for the quarter. Now, this performance was largely on the back of some significant releases that happened in the last quarter. These included Sanju, which had footfalls of 23.1 lakhs, and the GBOC, a gross box office collection of 51.2 crores. Stree had footfalls of 12.98 lakhs and a GBOC of 22.94 crores. Gold did footfalls of 9.91 lakhs and had a GBOC of 21.54 crores. Mission Impossible, 8.67 lakhs of footfalls, 17.50 crores of GBOC, and Dhadak did 7.4 lakh footfalls and GBOC of 13.52 crores. The top 5 films for the quarter, therefore, accounted for about 62.06 lakhs of footfalls. That's 45% of the quarterly footfalls, and GBOC of 126.69, which is 47% of the quarterly GBOC. As compared to last year, the top 5 films did 28% of footfalls and 30% of GBOC. So that was the content flow. Now coming into some of the parameters behind the financial numbers, overall footfalls improved from 127.5 lakhs to 136.7 lakhs. That's an increase of 7.2%, but that, as you know, was largely because our number of properties went up. Occupancies remained at about 25% in Q2 FY19 as compared to Q2 FY18. For the half year, footfalls improved from 285.7 to 292.9 lakhs. Occupancies actually fell from 28% to 27%, and that is because while footfalls increased by 2.5%, that's probably because our number of screens went up by about 9%. On comparable properties basis, which is, in the retail trade known as same-store basis, footfalls for the quarter actually fell from 118.3 lakhs to 116.8 lakhs. That's a fall of about 1.3%. Occupancies remained at 25% on the same-store basis. And for the half year, footfalls fell by 2.6% from 258.6 to 251.8 lakhs. Occupancies fell from 28% to 27%. Clearly, therefore, content in this quarter was not as good as content was in the same quarter last year. Overall, average ticket price has improved from 186 rupees to 195 rupees. That's about 5.1% growth in ATP. For the half year, it has improved from 190 rupees to 197 rupees, which is a 3.9% growth in ATP. For comparable properties, the average ticket price has gone up from 186 to 193. That's a growth of 3.8% for the quarter, and from 189 to 195, which is a growth of 3.1%. The second component of our revenues is food and beverage. There we've seen the spend per head going up by 13.5% from 65 rupees to 73 rupees for the quarter. For the half year, it went up by 15.4% from 65 rupees to 75 rupees. The net contribution has fallen marginally from 75% to 73.3% in the quarter, and from 76% to 74.5% for the half year. However, in absolute terms, the contribution from food and beverage, which is the spend per head minus the cost of goods, increased from 48.75 to 53.50. That's a growth of 10%. And for the half year, from 49.40 to 55.88, that's a growth of 13%. We continue to maintain the momentum of growth on advertising income that increased in the quarter from 32.1 crores to 37.8 crores. That's a growth of about 17.8%. And in fact, even on a per-screen basis, it improved from 6.85 lakhs to 7.42 lakhs, which is a growth of 8% on a same-screen basis. For the half year, advertising income improved by 18.9% from 65.5 crores to 77.9 crores. That's a growth, as I mentioned, of 19%. And even on a per-screen basis, the growth was from 13.88 lakhs to 15.70 lakhs. That's a growth of 13%. Other operating income was flat. 26.4 crores for the quarter last year went down to 26.2 crores for the quarter this year. And for the half year, the fall was 53.1 crores to 47.9 crores. So those are our key revenue components. On the cost side, tax cost, which is essentially GST, went up from 26.6% to 27.6% on NBOC basis for the quarter. For the half year, it went up from 26.6% to 27.4%, again on NBOC basis. Film distributor share went down from 46.5% to 44.7%, again on NBOC basis for the quarter, and for the half year, 44.9% went down to 44.4%. As far as other overheads per operating screen are concerned, these went up from 36.8 lakhs per quarter per screen to about 41.7 lakhs per quarter per screen. That's an increase of about 13% for the quarter. For the half year, 79.5 lakhs went up to 84.10 lakhs. That's an increase of about 6%. So those are the key highlights of our financial numbers. In terms of the new properties opened, we're extremely delighted to inform you that we've been able to not just maintain, perhaps outgrow our initial projections. We opened during the quarter 6 properties, 28 screens, and about 5,365 seats. This includes properties in Kakinada, which we opened on the 9th of July, 5 screens and 915 seats. Gurgaon Sapphire Mall, which we opened on 24th July, 3 screens, 567 seats. Pune Heritage Mall, which we opened on 1st of August, 2 screens, 428 seats. Coimbatore Prozone, which we opened on 20th August, 9 screens, 2,057 seats. Surat Reliance Mall opened on 22nd September, 3 screens, 539 seats. Gorakhpur City Mall we opened on 24th September. That had 3 screens and 742 seats. Delhi Epicuria we opened on 29th September, 3 screens, 117 seats. And after the end of that quarter, in the month of October, we already opened in the last 20 days. Mumbai Metro, 2 screens, 94 seats on 6th October. And Bangalore RMZ, 12th October, 5 screens, 1,317 seats. As a result of this, we are now operational in 19 states, present in 66 cities, with 132 properties, 536 screens, and 1,29,544 seats operational. We have grown on an average by adding about 8 screens every quarter since we started operations. What we expect to end the year by, beyond what we have already opened, we expect another 6 properties and 33 screens with 5,309 seats to be opened in the second half of the year, as a result of which, by the end of the year FY19, our total properties operational are expected to be about 138 properties, 569 screens, and 1,34,853 seats. In other words, we'll be opening about 77 screens in this financial year against the initial guidance of about 60 screens that we have provided at the beginning of the financial year. Beyond this, we have a very strong visibility of pipeline beyond FY19 based on agreements already signed. We have properties tied up to the extent of about 815 screens, 125 properties with 1,46,931 seats. And once this pipeline is fully implemented, will be about 263 properties, 1,384 screens, and about 2,81,784 seats strong. So that's as far as the properties pipeline is concerned. As far as content is concerned, we expect some pretty good releases to happen over the next few months. In November, for example, we expect on the 8th of November, Thugs of Hindustan to be released. As you might know, this is Amitabh Bachchan, Amir Khan, Katrina Kaif star from the banner of Yash Raj Films. And then there is 2.0 being released, again on 29th November. This, as you know, is the Rajnikant Akshay Kumar star. In December, some of the major releases expected are Zero, a Shah Rukh Khan star, Red Chillies Entertainment banner. Simba, a Ranveer Singh, Rohit Shetty movie. That's expected to be released on 28th December. In January, we expect The Queen of Jhansi, Manikarnika, a Kangana Ranaut starrer, expected to be released on 25th January. Again on 25th January, there's a Hrithik Roshan starrer called Super 30 being released. So pretty strong content pipeline as far as we can see over the next few months. In terms of the shareholding structure, there has been a little bit of a churn. SDFC Mutual Fund now owns about 5.2% of the company. It started buying in the last quarter. Reliance Mutual Fund has increased its stake from 4.1% to 4.9%. As a result of this, FIIs now own about 15% of the company. DII own about 20% as compared to 17% last quarter. We have treasury shares of 4.51%. The public owns 11.48%, and the promoters continue to own, as they always have, 48.7% of the company. The share price currently is about 231, which gives the company a market cap of roughly about 2,232 crores. We continue to have an extremely strong balance sheet with a very, very low leverage. Our net debt to equity is less than 0.38, and this does not include the value of the treasury shares. If you were actually to exclude this as well, the net debt to equity would be less than 0.2. We, as I mentioned, have treasury stock, which is at current prices valued at about 90 crores. There's real estate on the balance sheet, which is worth about 350 crores at market value. And as I mentioned, the promoter stake is about 49%. When all of these factors put together give us the potential to be able to grow and fund our expansion plans as may be required. So that, ladies and gentlemen, is a brief snapshot of our financial and operating performance. I would now like to open this up for any question that you might have. I have with me my colleagues Alok and Kailash also on the call, so I might even ask them to chip in with any responses. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Yogesh Kirve from B&K Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So if you look at the growth in the admits and also the occupancies, it's a weaker compared to what the overall box office performance has been during the content flow has been during the quarter. So is there something you would like to call out? I understand there would have been some impacts because of Book My Show issue.
Well, first of all, I don't know what the impact because of Book My Show would have been. Yes, we were not linked to that platform for about 3 weeks during the quarter. But it's always difficult to measure this impact because of the fact that content flow keeps on changing, and therefore there's no standard benchmark or uniform basis of comparison. We believe that the content flow has been weak. We also believe that typically Q2 is always weaker than Q1, and therefore we were not completely surprised by this. We think it's largely content flow driven rather than anything else.
Okay. So from what the box office or the content flow which has been there in the second quarter, we understand there would have been about 10-15% growth based on the data which is sort of available on various film magazines. So in light of this, the growth did appear a bit subdued. So I appreciate you cannot quantify the Book My Show impact per se, but any qualitative colors that if you could tell us about.
No, not really. As I said, frankly, it's difficult to quantify the impact, if any, of Book My Show. But as I said, I think it's largely because Q2 normally is weaker than Q1, and we do believe that if some of the content had performed better than what it did, the footfall numbers would have been better.
Right. And so secondly, in terms of the food and beverage spend per head, it was up by about 13.5% and has been growing in sort of a mid-teens over the last couple of quarters. So is this sort of a rate is sustainable? The growth rate is sustainable in the quarters ahead or the years ahead? And what has been the driver, with this kind of growth over the last couple of quarters?
Well, I think it is largely sustainable. I think we should be able to maintain the momentum of growth that we are demonstrating on our F&B revenues. I think it's a mix of two things. One is a higher conversion ratio. We've been able to improve our conversion ratio, which is measured as the number of transactions on the food and beverage counter versus the total number of tickets sold. We've been able to improve that consistently. In fact, the improvement in this quarter itself has been to the tune of about 8%. And we've also been able to improve the average price of a particular ticket on the food and beverage counter by about 4 to 5%. So I think it's a mix of both. At some places, we've also tried to rationalize food and beverage prices in response to popular demand. But we've also seen that in places we've done that, we haven't suffered a significant negative because of the fact that the hit rate or the conversion rate improved because of the rationalization of prices. So having regard to both that improvement in the average price as well as the hit rate, we believe that this kind of growth rate in the spend per head is sustainable over the long term.
Okay, sure. Thanks a lot. That's all for me.
Thank you. The next question is from the line of Darpan Thakkar from HSBC. Please go ahead.
Hi, thanks for the opportunity. I have two questions. One, if you can throw some light on what happened with Book My Show and how that issue was resolved. Second is any particular reason behind increasing other costs, sudden increase in other costs. It's like 31% increase per screen basis. Thanks.
So, I can only shed that much light on what happened on Book My Show. I believe we have stated earlier that they were, in our view, in violation of the terms of the contract. We therefore pointed this out to them. There was some time before they accepted that there was a violation, and therefore up to that time we had to, take INOX off their platform because we did not want to accept a continued violation of their rights. Eventually, both parties sat together and worked out a solution that was amicable and acceptable to both sides. And as a result of that, we have recommenced operations with them. So that's unfortunately as far as I can go into on the shedding light.
And any light on when that agreement with Book My Show is coming up for renewal or something?
No, I think the new agreement is already in place. The paperwork is yet to be done, but everything has been agreed upon, and based on that, we've already commenced operations on their platform. The documentation, of course, will be done over the next 1 or 2 weeks, but that shouldn't be a problem.
Okay. And on cost side?
See, on the cost side, I think, broadly speaking, you could break up the reasons for the increase in cost into 3 or 4 parameters. One is, as you know, there's been an increase in the number of screens that we opened. The number of screens, the average screens last year was about 439 in Q2. This year is about 480 in Q2, and therefore about 10% number of screens going up obviously would, even if you assume that the cost would remain the same on a per screen basis, lead to a 10% increase in overheads.
No, I'm talking about per screen, other overheads only that you have shown in the presentation. That's 30.9%.
Sure, okay, fine. So, had you mentioned that, then I probably would have answered that directly. So, on a per screen basis, if you look at it, the costs have gone up primarily because of 2 reasons. One is, of course, inflation. There's about a 4 to 5% inflationary impact on other costs. Secondly, there has been a one-off impact. You see, the food and beverages, which was earlier subject to an 18% GST and input credit was allowed, is now in the 5% GST impact, and input tax credit is disallowed. The impact of that input credit being disallowed in these other expenses is about, I would say, if the total expenses have gone up by 13% from 36.8 to 41.7, around 4.5% is because of the input tax credit not being allowed, and hence the net of that impact is about 8.5%. Of this, I would say around 4 to 5% would be inflationary, and the rest would be some one-off costs. For example, we had to incur legal costs on defending the food and beverage matter, which, as you know, was raging here in the Bombay High Court, and eventually we had to take it to the Supreme Court. There were some other one-off expenses on advertising because of having opened new properties, which would have explained that increase in cost. So largely the input tax credit not being available because of the GST on food going down from 18% to 5%, some one-off expenses and inflation.
Okay, thanks.
Thank you. The next question is from the line of Tejas Lakhani from Edelweiss. Please go ahead.
So congratulations on the set of numbers. Thanks for the chance to ask you the query. So my query is more with regards to the advertising revenue. Could you tell me how does this piece work for you? And also that given the fact that, the charges that you command on your screens, how does the advertiser validate the measurement, or how does he know the effectiveness of these ads?
I'm sorry, I don't understand your question completely. I mean, how do we measure the advertising revenues? For example, we charge on a per minute basis based on, say, 4 shows a day and 7 days a week. So we measure the total number of, minutes that we show the advertisement on and the rate. And the advertising revenues are a function of both those things put together.
So, sir, actually my query was that when the advertiser chooses to advertise on your platform, what is the measurement the advertiser gets? Like, how many people saw the ad, or what was the actual benefit of spending that money on the ad? So, like an eyeball, some sort of an eyeball metrics where he says that, this was the cost and these were the number of people who've seen the ad. So is there any measurement technique like this?
Okay, let me try and see if Alok can respond to that.
Well, we tell the advertiser the number of people who are there in the hall, and he knows the amount of money spent for that particular advertisement. And hence he can come to know the effective reach. And having said that, advertising in cinemas is better for him because he's got captive audience. So anybody who comes and sits in the hall has to see that particular advertisement of his.
That's a fair point. But Mr. Alok, one further follow-up is that your ability to tell him that, how many people are sitting in that hall would be a function of how many people have booked the tickets online, and you have that data beforehand. But I'm presuming some certain percentage also just comes across the counter and purchases the ticket. So how does it work?
So he doesn't need to know beforehand. We give him the attendance details after the show or the week is over, and he can always measure the efficacy of that advertisement based on how many people attended the show versus what is spent for that ad.
Okay. And sir, are we in touch with more national advertisers or local advertisers? And how does
it's a mix of both? Yeah, it's a mix of both. We have marketing outreaches both at the national level as well as at the regional and the local levels. And the advertisers are a mix of all these three segments.
So just to get a sense that, do these advertisers, do you have, like with the national ones, do you have like, they give you a budget and then it's like a 3-month, 6-month campaign, or is it like more spot kind of deals?
Again, it's a mix. Some are short-term deals and some are relatively medium-term to long-term deals. Obviously, the rates would vary depending on what kind of campaign is running, but it's a mix. I don't think you can generalize into saying it's just one category and not the other.
Okay. Thanks for that. Clear stuff.
Thank you. The next question is from the line of Urmil Shah from IDBI Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So just a follow-up, last year it was very strong as regards that it has been growth. First half, while the growth is decent, it is significantly lower than the previous year. Content would be one of the reasons. How should we look at the second half, given that content appears to be good?
Well, we do expect that if the content actually is going to be as good as we think it is, then the growth rate should be better. But also remember, last year's growth rate was a function of a relatively lower base, and as the base keeps on expanding, the growth rate in percentage terms, it's difficult to maintain that momentum in percentage terms. But even on that higher base, we have demonstrated an 18% growth, which I think is fairly decent. We could possibly have, our target was to do about 20 to 22%. So to that extent, it's slightly lower than what we were expecting. But that's also because we signed some long-term deals during this quarter, which had an average rate lower than our other, blended average. But we expect that to correct going forward. Since now we have a base load of those long-term ads, we'll add some shorter campaigns at higher rates.
Sure. So my second question was, you mentioned rationalization of, pricing selectively in the F&B part. And, that's visible partly on the gross margin for the segment. Should we expect the gross margin to improve from here on?
No, I think, frankly, I think you would expect the gross margins to remain where they are today, because whatever needed to happen in terms of rationalization of prices, as well as the impact of the change in the GST has already happened. And therefore, I think going forward, we should be able to maintain this momentum of growth as well as the margin profile on the food segment.
Sure. So we can take the Q2 number as the base for the gross margin.
I guess so, yes.
Sure. So, and lastly, follow up on the Book My Show issue. Even Q3 should have a partial impact. I mean, for the first 2 weeks.
Sorry.
Even Q3 should have a partial impact for the first 2 weeks.
Possibly, yes. I mean, there was a period, I think about 10 days, for which Book My Show was not operational during October. So, whatever impact that would have, that would be there. But as I said, it's difficult to quantify what that would be.
Right, sir. Thank you so much.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Riken Gopani from Infina Finance. Please go ahead.
Hi, sir. So just wanted to understand the F&B cost as a percentage of F&B revenues. That seems to have increased compared to the last year. Could you highlight what are the reasons for the same?
Well, I thought I already mentioned that what was happening was till last year, the GST rate on food and beverage was 18%, and you were allowed input tax credits on the food and beverage. Now, that rate has gone down from 18% to 5%, but you are not allowed input tax credit. And therefore, while the SPH is on a gross basis, and therefore for a 100 rupee food item, my cost would have gone up because the input tax credits are no longer allowed.
Okay, I thought you explained that with reference to the increase in other expenditure and not in the F&B cost. Maybe I missed that part, which is why I was...
Okay, just to clarify, maybe you did not misunderstand, but the impacts are twofold. First of all, the direct inputs which go into food and beverage are disallowed credits. So that's what goes in the COGS, so the cost of goods sold of food, which has led to the margins going down from 75% to 73%. In addition, what happens is you are also disallowed a proportionate GST on your other inputs, and that proportionate GST on other inputs which are disallowed, which are not necessarily food and beverage inputs, but to the extent that it is pro rata disallowed based on the proportion that food income has on your total income, that is reflected in other expenses.
Understood. That is clear now. The other question was with regards to the exhibition cost. That cost as a percentage to the box office collections has come down compared to the last year. Is that driven by, the longer duration of some of the movies, or is there something else to it as well?
Well, I think it's two components. One is slightly longer duration of the movies, but secondly also we were able to get a rebate in terms of the service charges which are allowed to be deducted in both Maharashtra as well as Gujarat. As you know, under the earlier entertainment tax regime, there was a service charge built into the legislation itself. Once GST happened, we had to work to get this promulgated, and this obviously takes time. We have now got this in about 5 or 6 states, but it's largely, last year there was no service charge allowed in Q2, but now we've been able to do that. So that has led to this reduction in distributor payouts as well.
So what would be a more reflective number once you achieve resolution across the majority states, according to you?
Well, I think it will be around this number, between 44 and 45% of NBOC.
Understood. And so just one last question on the occupancies itself. So basically, when I look at the top 5 movies occupancies, that have grown quite strongly, and it's the others which has basically declined significantly. Any specific trends that you would like to call out, or it's just content, because almost a 20% would be the decline in the other movies if I were to take out the top 5. Any specific trends, if at all, that you would like to call out here?
Well, no, not really. As I said, it's purely content-driven, and ideally, we should have the other movies also, perform better. In fact, I remember in more developed markets, the top 5 movies account for 15 to 20% of box office, because it's not dependent, the year or the quarter is not dependent on just 3 or 4 movies, but it's more widespread. Unfortunately, in India, the trend is the other way. As I said, we have no control over the content. We have to depend on what kind of content flows we get.
Okay, all right. Thanks. That's it from my side. Thank you.
Thank you. next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi, Mr. Asher. Just one, small bit, slightly more strategic. Now, if I look at, our last probably, 3 to 4 years, the screen addition, has been pretty healthy. So if I look at percentage numbers, probably, more like 8 to 10% on an average has been the screen addition over the quarters. The footfall growth is not in tandem, so it has been patchy, probably varying from a minus to a double-digit positive number. But net-net, the footfall growth has been slower than the screen addition. Just wanted to, have your thoughts whether it is a structural thing which will probably, continue to happen going ahead as well, or probably these are more impacted by content and probably, things will stabilize going ahead.
Well, I think it is more, I hope it is more impacted by content, and I hope the quality of content will improve going forward to ensure that we are able to maintain upwards of 28, 29, possibly 30% occupancy levels. It could partly be because of the fact that the number of screens that are getting opened, not just by us but by everybody else, will see some amount of cannibalization of audiences as a result of which, the people who watch movies get spread over more screens than less. But one hopes that the quality of content will keep on improving. Again, since the question is more, high-level, macro, strategic, I would like to say that in terms of number of screens per million population, India is amongst the lowest. We have less than 8 screens per million population, less than 3 multiplex screens per million population, whereas, as you know, internationally, many countries operate at about 10 times that level. So we do believe that there is ample scope for growth if the content keeps improving.
Sure, sir. Thank you, and that's it from my side. Thanks.
Thank you. The next question is from the line of Urmil Shah from IDBI Capital. Please go ahead.
Yeah, hi, sir. Just one more question on the screen addition. So this year appears to be really strong, but if we look at the last 4 to 5 years, it has been, uneven. So, if I had to look at the next 3 years, I mean, FY19 to 21, while the lineup is good, what is the kind of run rate you think should be bare minimum, and we should not have a repeat of FY18?
Well, normally we don't give screen addition guidelines on a year-to-year basis before the beginning of the year, because by that time we have a little bit more visibility on what kind of property developments are happening, what stage they are in, and how soon we would expect them to be, the property to be handed over to us, for it to be fit out, and for us to get the permissions. So it's difficult to say at this stage as to what kind of guidance we can give you for, say, FY20 or 21, except that I think it would be reasonable to assume that we would be able to add about 60 to 80 screens on an annual basis going forward. As you know, we'll do about 80 this year. We've done 60 in earlier years, so around between 60 to 80 should be a reasonable number to go by.
Sure. And if I can get the mix of premium screens as of date?
As of date?
Yeah.
Just a sec. We've got about 32 to 33 premium screens. We've got about 5 IMAX screens.
Okay, so in total about 37, 38.
That's correct.
Yes. Thank you.
Thank you. The next question is from the line of Rohit Dokania from IDFC Securities. Please go ahead.
Yeah, hi sir. Good evening. Thank you for the opportunity. Just 3 questions from my side. One is, can you update us on the, what is the, as of now, the status on the, legal matter on the F&B?
Okay. So I don't know whether you're familiar with what was actually happening, but following the writ petition that was filed here in Mumbai, a lot of writ petitions were filed in other states as well, which included Jammu and Kashmir, which included MP in Indore, which included MP in Jabalpur, which included Hyderabad, which included Delhi, which included Patna. So we had about 7 or 8 cases being filed in different high courts across the country. One high court had given a decision that, in a sense, went against us and therefore allowed patrons to bring food and beverage inside. And this was, curiously, the Jammu and Kashmir High Court, where I thought security would be more of an issue. But nonetheless, perhaps because the cinema side was not represented in that proceeding at all, That order went against us. We filed an appeal before the Supreme Court, and the Supreme Court was pleased to grant a stay and has effectively stayed the order of the Jammu and Kashmir High Court. Subsequently, we have filed a petition to transfer the Mumbai matter to the Supreme Court as well, because there's no point in fighting this in different high courts. So we thought we'll consolidate everything in the Supreme Court itself. So now the J&K appeal and the Mumbai matter are both at the Supreme Court. In the meantime, the other high courts have held in our favor, in the sense that the petition filed by the consumers to allow food and beverage to be brought inside cinemas has been rejected. And this includes the MP High Court at Indore, the MP High Court at Jabalpur, as well as the Hyderabad High Court. So all these have decided that it is not open for patrons to allow food and beverage items inside cinemas. And therefore, these matters were not necessary to be clubbed before the Supreme Court, because the orders were already passed in our favor. So currently, the Supreme Court next date of hearing, I believe, is on the 29th of October, where the matters will be further argued and heard.
Great, so this is very helpful. Thanks for the detailed response. Just two more things from my side. One, you were explaining to some other participant earlier in terms of the increase in overall other expenses, not on a per-screen basis. You spoke about inflation. I think you also spoke about the GST impact of ITC. You said there were 3-4 reasons. Could you please elaborate on the other two?
So, one of them was the increase in the number of screens. Number of screens have gone up by about 9 to 10%. So, obviously, in absolute terms, the expenses or the overheads on a total basis in my P&L account would go up by 9 to 10% because of that. The second reason for impact is the proportionate disallowance of input credit in my other costs. For example, we have manpower contracts, we have service contracts on which we pay GST. And to the extent that food and beverage constitutes, say, 30% of our total revenues, 30% of the input tax credits on those items needs to be disallowed. So this accounted for about...
Including rental as well, I would assume.
That's correct, including rental as well. So this proportionate disallowance led to some cost increase, which is reflected in the other expenses. And then there were some kind of one-off expenses. For example, I believe we spent about 3 to 4 crores on legal expenses on the food and beverage matter, because we had to retain the best of counsel both in the Mumbai High Court as well as the Supreme Court, and that led to some costs. There were some one-off costs as well, and then, of course, there was inflation. So, those are the 4 broad categories as a result of which the other expenses went up.
Sure, so fair enough. Just last question from my side. Could you please help us with the share of online booking both in Q1 and Q2, Q1 FY19 and Q2 FY19? So, and the percentage of total footfalls?
Overall, online booking was about 44 to 45%. 44% in Q2 FY18, 45% in Q2 FY19.
Q2 FY19 was 45%, sir?
That's correct.
And how much was sequentially, sir, in Q1 FY19?
Okay, I don't have that in front of me. Just a moment. I'll see if somebody can. 47%.
47%. Sure, so this is very helpful. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Akash Shah from PMS Securities. Please go ahead.
Hello.
Yes, please.
Hello. Am I audible?
Akash, please go ahead.
Yeah, my question was with respect to whether INOX is planning any inorganic acquisition, especially in southern states.
Well, INOX has always been willing to look at any sense-making acquisition opportunities. In fact, I might say that we, in a sense, began the consolidation phase in the multiplex sector by acquiring 89 cinemas way back in 86, I believe, and then we acquired Fame, and then we acquired Satyam. So we've been looking at acquisition opportunities, but our strong belief is that it should be done at a value that makes sense for our investors, and therefore there is a certain threshold above which we would not like to pay for acquisition opportunities. But if you find something which makes sense, which is complementary to our existing footprint, and which we can acquire at a value which we consider to be reasonable and affording a good return on investment for our investors, we would certainly look at it.
Okay, question.
Excuse me, this is the operator. Mr. Shah, your voice is breaking.
Okay, I'll get back again. My line.
Thank you. The The next question is on the line of Girish Pai from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity. I just want to ask a question on the other operating revenue and how much of that is coming from convenience income or rather from the ticket aggregators. For instance, 2Q of FY19, you had 26.2 crores. How much of that would be income from ticket aggregators, and what would the other part form? I mean, what would the other income be? I mean, non-ticket aggregator related other income.
So, again, one is, of course, the ticket aggregators, what we call convenience fees. Then there is a virtual print fee or a VPF. It's a fee that we charge our distributors for to compensate for the cost of the digital projection equipment that we invested in. And for some properties that we own ourselves, there is a conducting fee or a rental income. And then there is a entertainment tax subsidy, which is a hangover of the earlier entertainment tax regime that is credited to this head. And then there are some other sundry, parking fees and other revenues. So it's a mix of 5 or 6 different components.
So of this 26.2, how much would be the ticket aggregator related convenience income?
Well, I wouldn't like to share the exact numbers with you, but that I think would be the larger portion. It accounts for less than half of it, but certainly the larger portion there. Okay.
Now, the new deal that you may have probably signed with BMS and maybe even Paytm versus what you were getting previously, what would be the multiple be like? Because your competitor has come out with a certain deal which is at a significant premium to the previous deal that they had signed. Would be along those lines, or would it be different from that?
Well, first of all, I don't think it's directly comparable because what we have negotiated and the kind of deal that we intend to sign with the aggregator now is completely different from what our competitor has done. So in that sense, the way the rights between the two sides have been carved out for each other are completely different. And in that sense, it's not a comparable number. All I can say is it's significantly better than the deal that we had hitherto, which is before 1st of October.
Okay. And of this 45% online booking, how much would be coming from ticket aggregators?
About 40% of it.
Okay. Thank you.
Thank you. The next question is from the line of Vahishta Unwala from Care Ratings. Please go ahead.
Hi. Good evening. Congratulations on your quarterly performance. My question is with the fast penetration of OTT players like Netflix, Amazon, etc., which is supported by the low subscription rates and low data rates, do you see any impact in the near term on your occupancy rates, footfalls in the near term, maybe in the next 3 to 5 years?
We don't believe so. First of all, we believe socially going out for a movie experience is always a very, enriching social as well as family experience, and people will continue to want to do that regardless of availability of other options within, under their roof itself. Secondly, commercially also, there is a restriction on playing of content on other platforms other than theatrical exhibition. The distributor cannot release that content on other platforms for at least 6 to 8 weeks after the commercial release of a movie in a cinema theater. And that will ensure that, there is no direct competition between these other platforms and cinema exhibition because content will be shown, at least mainstream Hindi or English or regional content will be shown in cinema theaters exclusively for a period of 6 to 8 weeks before they are available on other platforms.
Okay, all right. Thank you, sir.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Rishabh Bothra from Sharekhan. Please go ahead.
Hello, sir. Just wanted to understand, in case our content pipeline is strong, can we have a better ad revenue or the increase in the number of minutes?
Yes, I think so, yes. Except that, the impact is not as direct as, for example, in ticket prices. So, if we have great content, I can increase my ticket prices tomorrow itself. For advertising income, there's a little bit of lag between the flow of content and the improved revenues. But yes, one would expect that in the long term, advertising revenues would improve as content quality improves.
So you mean to say that better footfalls due to better content will help in negotiating with the advertisers for the coming quarters or so?
Yeah, that's correct. Except that, as I said, the impact is not immediate. It's more on a sustained and a lag basis. But yes, it would happen for sure.
And till how long does the advertiser contract remain so in force? Is it for a quarter or movie by movie?
So as I said, there are different deals. There are long-term deals where there are 6 to 12-month contracts. There are short-term deals where there could be a month to 3 month kind of contract. So it's a mix of different types of transactions.
Okay. And in lastly, on the other operating expenses, I guess the GST input credit and the inflation part will remain so. Only the legal expenses part will go off. So this could be a new norm in case of increased other operating expenses.
Yeah, that's correct. The one-off expenses will not be repeated, but the GST input credit not being disallowed and the inflationary impact, and of course the new property impact, because if you open screens at the rate of 9 to 10%, then that impact will remain.
True. But any cost improvement areas where we can see margin expansion, or how is it?
Yeah, one thing I must also mention, and I think that has got missed out by you analysts that you haven't observed, is the fact that the spend per head on F&B went up by 13.5%, right? From 65 rupees to 73 rupees.
True.
The occupancies went up by around 7%, from 127.5 lakhs to 136. So you have 7% more footfalls, spending 13% more on F&B, which would logically add up to about 20%. But if you look at my F&B revenues, that has actually gone up by 41%. And that's because my F&B revenues are demonstrated here on a net of tax basis, and the impact of the lower GST is reflected in the higher net revenues.
Okay. Fine. Thank you, sir.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Raghav A., an individual investor. Please go ahead.
Thank you for the opportunity. My first question is, are we looking towards foreign expansion?
Sorry, can you repeat that question? Are we?
Is INOX looking towards foreign expansion as other companies have already logged in for that?
No, well, at this point of time, no, we don't have any such plans.
And other than that, what's the strategy towards the south? Are we looking for inorganic expansion or only the organic one?
No, we are happy to look at organic as well as inorganic expansion. I thought I'd already answered that question in response to an earlier participant on this call. We have already been looking at acquisition opportunities, but we want to make acquisition opportunities which provide an adequate return on investment. So it should be at a sense-making value, and it should be complementary to our existing footprint. So if those two conditions are satisfied, then yes, we'll be happy to look at anything that comes our way. We would not like to, pay multiples which are so rich that the return on capital employed for us would go down significantly. So at a sense-making value, yes, we are happy to look at acquisition opportunities.
Okay. Can you also give an idea about what is the pipeline for the premium properties in the coming next 2-3 years, or like what is the approach for the premium properties?
No, frankly, we aren't sharing that information right now. We'll announce that whenever we are ready with the premium properties.
Okay, thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments.
So, just to round this up, I believe that the performance of this quarter has been slightly subdued because of the indifferent content. And to that extent, even though our property opening has been much stronger than what we had ourselves anticipated or given guidance on, that positive has to some extent been diluted by the negative because of indifferent content. One hopes going forward, as the content flow is expected to be much better than what it was in the last quarter, and our property opening rate continues to maintain the momentum it has demonstrated, our numbers going forward should hopefully look better than what they did last quarter. With these words, I'd like to thank all of you for your interest, for participating in this call, and I look forward to your continued support and interest going forward as well. Thank you.